Yeah, so my career in asset management began in managing global bonds and currency. So I have a very global perspective. Our team has worked together for a long time now, over 2 decades. What this means is that we've managed money through many market cycles. So for example, during the GFC, when we had a lot of redemptions and a lot of market volatility and liquidity being impacted, it taught us how to manage those sort of conditions and manage those risks. So when we had the pandemic hit recently, it meant that we had the experience of the GFC to draw on, and it meant that we could actively manage the portfolio, not only to protect on the downside going into the pandemic, but then to actively take advantage of opportunities on the other side of the pandemic. And in the income strategies, what this meant was that we made twice as much in return post-pandemic as we lost on the dip going into the pandemic. Our team's combined expertise means that we're credit specialists and active managers, and for investors this means strong risk-adjusted returns and good downside protection. Yeah, so credit is a global market, and within that market, Australia offers some unique advantages. Australia is a relatively small economy compared to many of our global peers, and what that means is a lot of the corporates in Australia are either oligopolies or monopolies. And whilst this isn't great news from a consumer's point of view, from an investor's point of view, it means that these companies are profitable with high margins, strong balance sheets, and resilient to economic cycles. So market cycles driving asset performance basically are driven by economic cycles, and then of course this is intertwined by central banks' responses to those economic cycles with what they do with interest rates, and that of course affects credit cycles. So there's a lot of interrelatedness. In terms of contrasting fixed rate bonds with floating rate bonds, unlike fixed rate bonds where you have the capital price that moves inversely to movements in market rates, with a floating rate portfolio, movements in interest rates affect the income generation rather than the capital price. So the team's approach to risk management recognises that credit risk is asymmetric, and by that I mean you can lose your entire capital in the event that a company defaults. And so unlike equities investing, where you're looking for blue sky, with credit investing you're actually looking for what can go wrong and how to try and screen that out or mitigate that. Diversified Income Fund has been designed for the defensive part of people's portfolios. It's designed to offer low volatility, regular income and daily liquidity. DIF is intended for those investors that are willing to tolerate a little bit of credit risk, which is predominantly investment grade, and who are looking for a cash plus return. Our process for screening opportunities for the fund is twofold. So the team meet fortnightly to set our team's risk appetite for the coming 3 to 6 month period, and that's called our credit score, and that varies on a scale of +or-4. And then the second element of that fortnightly meeting is generating the team's matrix of preferences, which is specifically looking at where we want to add or reduce risk in relation to 3 key characteristics, being credit rating, maturity bucket and industry sector. So in constructing my portfolios, one of the key things I look at, acknowledging that it forms the defensive sleeve of people's portfolios, is generating tightly risk-controlled outcomes. So that downside protection is super important. But importantly, you can see that good risk control hasn't come at the expense of returns. We've delivered market-leading returns over the short, medium and long term.